Two stocks, Walmart versus Cisco. We've been saying all year long that the consumer has been strong and been the engine of growth in the economy versus global growth slowing down, particularly China. And this was completely the case with both of these stocks today, right? I mean, Walmart did a lot of good things that, internally to actually have good results. But the consumer traffic was great. Same-store sales, two-year basis, 7.3%, really good showing. Cisco, on the other hand, China was a big problem for them. That was one of the reasons why they actually had to lower guidance. So it's like the tale of two halves, right? You want to be involved in the consumer, and you probably want to just be careful on the cyclical side of things.
Let's add in David Zervos, Chief Market Strategist at Jefferies, to discussion. Great to see you, David. As always, does the macro data of late match Stephanie's micro summation of the kind of state of play at the moment as well? Strong U.S., weak international.
It definitely does. I think the strong U.S. data is actually pretty amazing. You had the Empire, the Philly Fed, a lot of other pieces of data and productivity data, all pretty good, and the bond market's just shrugging it off. So I think there really is this international push, the Bund breaking to over negative 70 or under negative 70, I should say. And I think there's another thing going on in the bond market. We've seen bond market volatility as measured in the MOVE index, which is like the VIX for bonds, touch levels that we haven't seen since 2016. And I think we're seeing a lot of stops. People had curve steepeners on. They're getting out of those. It's really, there's a lot of positioning in the bond market that may not be as informationally valuable as we're trying to read into it. So I think I want to watch how this bond market progresses over the next couple weeks to see if the bond market isn't just kind of having one of those cathartic sessions where we have to get a bunch of people out of bad trades, and then we can actually get the bond market to give us better signals for what's going to happen in stocks.
That is a key point that David is making right there. I mean, especially when we talk about the yield curve inversion and the fact that that historically has been seen as a recessionary signal. We were talking about it a lot yesterday. You had the Dow down 800 points, probably spooked quite a number of people who maybe don't even regularly check their portfolios but see a headline number like that. What do you think the bond market is telling us? And are we talking too much about the rising risk of recession right now to the point where we could actually talk ourselves into a recession?
Well, you could talk yourself into recession if you get business confidence and consumer confidence to start to deteriorate. So far, so good, though, on that front. Both remain elevated. Look, I mean, I think that the bond market, it's obviously very complex because we do have slowing growth here as well as abroad, right? I mean, that has been known, right? And so that's one of the reasons why the long end has actually been coming down, right? But, I mean, at the same time, I mean, lower rates around the world, it's like central bankers are like fighting to get to the lowest rate. And so naturally, it's kind of like, where are they going to go? This is the best rate here. And so I think that's really what it is, much more fund flow driven versus fundamental driven, even though we are slowing. But we're not going into a recession.
David, should the Fed cut by 50 basis points purely and simply to re-steepen the curve?
I think, well, Wilf, I always answer those questions on, what the Fed should do by saying nobody really cares what I think the Fed should do. It's what they're going to do. That's what our clients like to hear from people like me, is what I think they're going to do. I think you can make a case for 50. I think it's a reasonable case. I think the inversion really matters. And I think, Jim Bullard's been one of those guys that's pushed that pretty hard. But again, I'll go back to my first set of statements. I think, this bond market wasn't meant to be here. This is a heck of a rally. It's gotten a lot of people forced in. One thing I didn't mention in the last little blurb was also you have this thing called mortgage convexity hedging, which sounds awfully complicated. But when we start to see big refinancings in mortgages, people have to buy more duration. And so a lot of this information, we're trying to glean information from the bond market for the stock market to say, recession's coming, the curve's inverting, there's a big move, it's telling us something really negative, and the Fed needs to react to that. Let's watch the positions. It's August. It's, liquidity's not great. This is actually, as I've been recommending to our clients who kind of participated in the strength of the stock market and the bond market for the start of the year, this is not a bad time to be on the sidelines and watching it. And I think we'll get some better information from the bond market in the coming weeks as people come back. I'm not at all convinced that we have big recession risks on the horizon.